Welcome, this is Najma Minhas with Global Village Space. I'm joined today by Mr. Javed Hasan, a former investment banker and chairman of the Economic Advisory Group. Pakistan is in the grip of an economic crisis. The rupee has devalued by over 13 rupees. It's currently trading in the interbank at around 194. The open market tends to be a 1 to 2 rupees more than that. The stock market collapsed by over 2.5% today alone, and 3,500 points is lost over the last 1 week. Javed, why have we reached this situation?
Well, Najma, we have a perfect storm brewing here. We have political instability. There's no clarity as to where this government, how long it will last, what its mandate is. We have a huge trade deficit, which is growing. It's about 1.5 billion every month. On top of that, our reserves have dramatically fallen, and we are out of the IMF program at the moment. So we don't even have a lender of last resort we can come to. And because we don't have that, monies from Saudi Arabia, UAE, and China are not coming. So effectively, we are running the risk of potentially having a default in anything between 8 to 10 weeks. If we're lucky.
Is it absolutely necessary we need to get into this IMF program?
Absolutely necessary. There's no way out of it. If we don't get back into the IMF program, we will almost certainly, like Sri Lanka, have a default position in anything between 6 to 10 weeks. The precise numbers can't be obviously said.
Mr. Saab, when he came back from his meeting in Washington, referred to the fact that they'd asked for a $2 billion extension and an extension of 1 year as well in the program. What do we need to do, and what is the likelihood of us actually doing those things to actually re-enter the IMF program?
I think before we talk about the extension or expansion of 2 billion, let's talk about first getting back into the program. And that's what's critically important. And there are a number of things that IMF requires us to do. The outgoing government or the previous government had introduced some subsidies, basically, and frozen the oil prices, both diesel, petrol, and kerosene. And at that point, the global prices were around $95 for Brent, and rupee was at around 178. Since then, oil prices have gone up to, or crude prices have gone up to 110, and moreover, rupee has gone up to now 194. So effectively, you have had a double whammy. You're having a situation where your subsidies, which were initially when the PTI government was there, had been costed at around 65 to 80 billion. Today are costing per month about 110 to 130 billion. And this is even before we account for petroleum levy, which used to also go into the exchequer. So the government is out of its own pocket, having to subsidize fuel consumers to the tune of anything, as I said, 110 to 120 billion. And that is growing, that number.
Just to bring it down to a more ground level, my understanding is that the subsidy on petrol is around 47 rupees on latest landing cost per litre. So 47 rupees the government is paying for every 1 litre that you and I or anybody's buying. On diesel, it's around 86 rupees. Is it even possible for any political government to make this kind of decision?
It has to be. I mean, if the subsidy had not been given, it would have been just fixed in line with what OGRA recommendations are. The OGRA recommendations are in that tune. The fact of the matter is that in other countries, Pakistan has a significantly lower oil prices, whether it's diesel or petrol. It also is important to know when you give such a huge subsidy, people tend to consume more, and it increases our import bill just at a time when global prices are going up. So in fact, one of the ways to curtail consumption of, even though it's not that elastic, but it would have helped curtail some consumption if our oil prices were in line with international markets. It's quite simple. The country's chancellor, the country's treasury doesn't have the funding required to subsidize to the tune of 110 to 120 billion every month. And this number might actually grow. Our fiscal deficit, this is the primary fiscal deficit, is already above 1 trillion rupees. That was supposed to be near zero, or a maximum that IMF in its conditionality had allowed. If I know precise numbers, I don't know, but it's about 100 billion. So we are running something like 9 times or 10 times more than what IMF had allowed to be part of the IMF program.
I came across a tweet by Dr. Ali Hassan. He is in the, I think it's LUMS, Department of Economics in LUMS. And he referred to the burden of the fuel subsidy being equivalent to losing 90% of any income tax we collect. I mean, that's a crazy amount. And of course, government of Pakistan can't afford it. Inevitably, they're going to have to increase the fuel subsidy. The question is whether a political government is going to increase it or an interim government is going to have to come in to do that. But you refer to the trade deficit, and I'd like to talk a little bit about that. I know that the last Commerce Minister, Razak Daud Saab, had been talking about the fact that we have record high exports this year. And he was talking about it until late March. So what happened that we have this huge trade deficit?
Well, there are two reasons. One, something which we have already mentioned, global commodity prices have gone up, which have increased both food, one of our major import items, and as well as the oil prices. Oil prices have increased by anything between 70 to 80%, and food prices are not very far off. So you've had basically in our major import basket of about 70 to 80% increase in the price in dollar terms. And that would obviously have a dramatic impact on our import bill. The other thing that is also true is that the previous finance minister, Shaukat Tareed, had given a fiscal stimulus, which has boosted growth. And that has also had an impact in terms of creating more demand in the economy than would have been probably wise at this moment.
So what's the solution for restraining the trade deficit?
Right now, the only way to really restrain the deficit is to considerably slow down the economy. We need to increase interest rates. We need to have demand compression, or in simple terms, we need the level of demand to come down, and we need to hopefully export more. But the exports have increased by about 30% anyway, year on year. So really, there's not too much space to do that. What we really need to do is reduce the deficits that we have is by reducing demand in the country. And that is quite simple. You increase interest rates and you curtail overall aggregate demand. There is talk of putting stops on luxury items. On the whole, it has been seen that these kind of efforts by putting stops on luxury items do not work.
Yeah, tackling small cheese imports or chocolate imports is not really
Those
the
are
solution.
superficial.
Yeah. So we have now a state bank that's independent, an autonomous state bank in Pakistan. So therefore, increasing interest rates is really its mandate. Do you see that happening? I mean, they've already increased it by 2.5–3%, I think.
Well, they have increased it since the last monetary policy by about 2%. You're absolutely right. But they were not ahead of the curve. They have been behind the curve. The current policy rate is about 13.5, I think. And the actual market treasury rate is trading at around 15%. So you're seeing already the treasury rate, what the policy rate is well behind. So you will have a catching up with the market that will take place. Given the inflationary trend, which is probably going to be close to 15% this month, overall CPI inflation, food inflation will be higher. And then we are going to see even further increases in inflation rate. It might go up to 17–18%, according to a number of analysts. We would have to have interest rates, if we want to have real interest rates, probably closer to, again, 18–19%. So that seems to be a case where the state bank has been a bit lax. But this is true for central banks all over the world. They thought that the inflationary pressures around the world are transitory, but they have been proven wrong. The inflationary pressures have been much more sustained. And there's one simple reason for that, quite apart from the supply chain constraints and disruptions that took place because of COVID. But there was this enormous shock which we are all aware of, which is Ukraine war. And that has basically taken supply in terms of both food commodities, sunflower oil, for instance, edible oils, but also petroleum products.
Okay, so I'd like to touch upon just two things that you mentioned. One is the foreign reserves that have dropped by over 6 billion. I think it was when Imran Khan's government left, left these around 12th of April, around $16 billion. They've now come down to $10 billion. What does that mean for Pakistan? And also I've noticed that recently credit default swaps, which is a little bit technical. So if you could explain how those have jumped and what does that actually mean for Pakistan?
Okay. I think both are very important, and basically that's what we really focus on in terms of default. When the government left, Imran Khan's government, the state bank reserves, their overall reserves, which is the liquid reserves, which includes what is there in banks, but that's not the government's money, that's not the state bank's money, they should not touch it. The state bank's reserves were about 16.2 billion. That has come down to us as of May 6th, probably lower now, but May 6th, it was 10.3 billion. We have to remember 10.3 billion includes the 3.2 billion of Saudi Arabian money, plus it includes some Chinese deposits of about 1.5 billion. So once you take that out, we are actually left with actual reserves in our hands, probably close to about 6 billion. Now we have to make payments of about 2 billion over the next 2 months. So that leaves us with 4 billion. On top of that, every month we are running a trade current account deficit of 1.5 to 2 billion. So basically in about 8 weeks to 10 weeks, we'll run out of foreign exchange reserves unless money comes in from, IMF, which was about $1 billion, plus there was supposed to be some money coming in from Saudi Arabia and China. But none of that will happen unless it happens from IMF. Credit default swaps, very quickly. It is basically, what are the credit default swaps on 1 year or 3 years lending? There's an insurance premium, effectively, if you want to think about it that way, that banks would charge Pakistan or any borrower borrowing in dollars externally to make sure that if there's any default risk. That used to be before the vote of no confidence. It's quite interesting. That used to be about 4.8%. And after the vote of confidence, it suddenly jumped almost double. Or once the vote of no confidence was stable, to about on 8th of March, it was around 9%. So you had a dramatic shift in the vote of in the credit default swap, the premium that was required. And effectively, at this rate, one was cut off from the international markets in terms of borrowing. These are near default rates. So the political instability has had a dramatic impact in our ability to access international markets. It has to be said also, the other countries which are lending to us or rolling over their debt, they would also be looking at credit default swaps and thinking, my God, this country's risk is getting worse.
What exactly is our debt situation right now?
That's, if we look over the next 24 months, we have approximately about 36 billion that has to be repaid. It's almost 18 billion per month, per year, sorry, in the next 12 months, about 18 billion that repayments, including interest payments and principal payments that have to be made. This is 18 billion, and this is in terms of financial payments that we have to make. On top of that, we have to remember, at present rate, we are running a current account deficit of 1.5 billion, which has to be financed by borrowing. So if you add that over 12 months, that's another 18 billion. So potentially we need 36 billion, 35 to 36 billion over the next 12 months. Now, hopefully, we don't need it and the current account deficit comes down. And that's why it's so critically important that the current account deficit, because there's other payments to make. Now, everything starts looking better the minute we are back in IMF. Because once you are back in the IMF, some of this 18 billion may not need to be paid back. What could happen is a lot of this could be rolled over. Rollover means that whatever loan you have, your borrower, he says, okay, I'll roll it over for another 5 years, 2 years, 1 year, whatever. If we are not in IMF, the chances of getting rollover are virtually zero.
Is there any light at the end of the tunnel for Pakistan right now?
The light of the tunnel is that the governments, whichever government, whether it's the present government or an interim government or a new government, has to take tough decisions. We just simply can't afford to continue in the merry old ways that we have gone on. These subsidies on fuel, as painful as they are, will have to be withdrawn. The oil prices, diesel prices, petroleum prices will have to be increased. Even if it's not simply a question of IMF, even the budget deficit was such that we simply can't afford it. The government has to go and borrow in the markets. It can't print any money now. So if it borrows in the markets, interest rates start shooting up. With this kind of magnitude of borrowing, we can't afford. We can't afford to have subsidies. Dr. Hassan, you mentioned if you think about it, at current levels, it's the total federal spending, including bureaucracy plus parliament plus everything, is annually is about 450 billion. We would have blown away this money in just 4 months, just the entire running of the federal government, just to give you some idea of the magnitude of subsidy that is taking place.
So Pakistan has to take tough decisions and has to enter the IMF program.
There is no alternative to that.
Javed, thank you so much for sharing your thoughts with us today.
Thank you.